The S&P 500 is the benchmark of champions, returning an average of 10% annually. For most, matching it is a dream. For the elite, it's a floor. I'm Roldan Ferrer, with over 25 years navigating the complexities of institutional finance. I've seen cycles turn, bubbles burst, and fortunes made in the margins. Today, we aren't talking about safe indexing. We are talking about alpha. I'm going to show you how to construct a satellite portfolio, a sophisticated tactical layer designed to wrap around your core holdings and propel your annual returns beyond the S&P 500. This isn't speculation, it's mathematical precision. To beat the market, you must first respect it. We use the core satellite architecture. Your core remains 70 to 80% of your capital in low-cost index funds like VOO or IVV. This ensures you don't fall behind the beta. But the remaining 20 to 30%, that is your satellite. This is where we apply concentrated bets. While the S&P 500 is market cap weighted, meaning it's heavily skewed toward mega-cap tech, your satellite portfolio focuses on factor investing and disruptive divergence. To beat the index in a 12-month window, we cannot simply follow the index's rules. We must exploit its inefficiencies. To outperform in a one-year horizon, we look at three specific levers: relative momentum, mean reversion, and thematic tailwinds. First, we analyze relative strength. We look for sectors outperforming the S&P 500 over a 6-month look-back period. If semiconductors or energy are leading, that's where our satellite rotates. Second, we look for quality at a reasonable price, or QARP.
We want companies with a return on equity above 20%, but with a price-to-earnings ratio that hasn't yet caught up to their growth rate. Most investors fail because they are too diversified. In your satellite, concentration is your friend. We are looking for 5 to 7 high-conviction positions, not 50. Institutional alpha also requires understanding the macro overlay. In the next 12 months, the S&P 500 will be held captive by interest rate volatility. A smart satellite portfolio hedges this risk. If the S&P 500 is top-heavy, your satellite provides the balance. We use a Black-Litterman model approach here, combining market equilibrium with our specific expert views to tilt the portfolio weights optimally for the current environment. However, you cannot beat the market if you are dead. High-performance portfolios require active risk management. Unlike your core index, which you buy and hold, the satellite requires a tactical rebalancing every quarter. Use a volatility-adjusted position sizing, similar to the Kelly criterion. If a satellite position becomes too volatile, we trim it. If it loses 15% of its value, we exit. We are hunting for asymmetrical returns, where the upside is 3 times the potential downside. This mathematical edge is what separates the professional desk from the retail trader. Beating the S&P 500 isn't about being lucky, it's about being structured. By maintaining a solid core and aggressively managing a sophisticated satellite, you position yourself in the top 1% of global investors. I'm Roldan Ferrer. If you want to dive deeper into the specific tickers I'm watching for my own satellite rotation this quarter, subscribe and check the links in the description. Finance is a game of information. Make sure you have the best. See you in the next briefing.